Alistair, a question, and this is really based on the Australian economy. Yeah, I mean, I'm sure you have a little bit of an idea of what's going on in the world, what's is happening in Australia. Darren, I can see that. I mean, we just finished off a month, and it was nearly record sales of gold and silver. Very, very busy. But what we have also noticed, probably in the last 6 months especially, is that people cannot pay their bills. And they're quite incredible. Their mortgages are rising, the energy bills are rising, and they're coming in, and they don't want to, but they're selling some of their silver, some of their gold, just to pay their bills. And then I read an article, and I'm going to read the parts of this article out to you. So from Australia comes the headline: Australia's private sector economy tanks. Tanks in Australian words, I don't know if it's in British, but tanks is going down. The first quarter national accounts released early this month showed that the private sector economy remains locked in recession. Australia's per capita GDP declined by 0.2% over the quarter, the ninth decline in 12 quarters. That's incredible, the ninth decline. But Darren and I know that this is happening today. It was also the longest, but not deepest, decline in GDP per capita in modern recorded history. Now, we've been under a fiat currency now, as you know, Alistair, for 54 years. And I just want your thoughts. Is government spending holding up the economy? Or what's your thoughts about what I've just said?
Yes, government spending in most jurisdictions is holding up their economies. We have exactly the same problem in the UK, also in America. If you strip out particularly the government deficit on its budget and take that out of GDP, because virtually all the deficit actually does go into GDP, then you get a very different picture from what economists and governments actually tell us. The other problem we have is that government statistics are not worth the paper they're written on. So how can you judge these things? I'll make a further point. GDP doesn't give you any idea as to what's going on in the economy other than the expansion or the contraction of credit.
Yeah.
How is that credit being deployed? So you've got all these questions. And then when you look at applying a deflator, say, to try and sort of adjust it for purchasing power, you look at the measure of consumer price inflation. Now, in most jurisdictions, that bears no relationship at all to what is actually going on with consumer prices. It's in government's interest to keep that level down as much as possible. And that is the way their statistical departments work. And to me, it is quite extraordinary that markets hang on every word of labor statistics, inflation statistics, and if you like, the FOMC meetings from the Fed and so on. As if this is gospel. I mean, gospel may require a certain amount of belief, but I think in this case, when it comes to governments, their gospel requires the suspension of belief, I think, as a starting point. So, to my way of thinking, this GDP number, what you have said is a better reflection of actually what's going on in all our economies than what government statistics are saying. Now, this is terribly important because of the amount of debts that governments have racked up. That debt needs funding. And of course, they don't pay interest, they just roll it all up. But if you're going to have creditworthiness in the markets, in other words, if people are actually going to buy this debt, they have got to have the feeling that the underlying income, in other words, the tax receipts from the private sector, are going to cover the costs of the debt. I mean, at the least, it should cover the interest cost. But if it doesn't, then the debt just runs away. And you have effectively a debt trap. So what happens to interest rates? Well, they have to reflect the increased risk, which means that bond yields rise. It doesn't matter what the what the central banks do if they want to cut interest rates. They'll just crucify their own currencies. But when it comes to actually getting lenders to lend to governments, and once they understand that there is a debt trap problem emerging here, then bond yields are going to rise, and they will rise, and they will rise. And I quote so often what happened in this country back in the mid-1970s, when we were in a debt trap. The IMF had to bail us out and actually force the politicians to cut public spending. And this is now an issue in this country today. I don't know whether it's sort of got any airtime abroad, but what happened then was that bond yields rose and rose and rose, and medium-term bonds they had coupons of 15 and a quarter, and 15.5%. Now imagine what that does to every government's finances. That is the problem, which actually we do face, and it's part and parcel of the end of the fiat currency era, because this time, last time in the UK, I think I'm right in saying that the debt to GDP, government debt to GDP, was in the order of about 50%, something like that. Today it is 100%, probably a bit more if it was properly accounted for. So we've got double the problem.
Yeah.
And so far, nobody's really recognized it. And I think this is beginning to filter through with people saying, hold on a minute, how is this going to work? Should I buy sterling gilts, or should I sell what I've got? Is the risk in this? Should I sell my U.S. Treasuries? In the case of U.S. Treasuries, of course, the dollar has gone down, and it's lost over 10 to 12% in about the last month or 6 weeks. So you've got a guaranteed loss. Where's it going to go from here? Do we reduce our 40 trillion? I'm talking collectively as foreigners. Do we reduce our 40 trillion, or do we just try and sit it out? At the moment, they're sort of sitting it out. Do we buy any more with a cash-strapped US Treasury? I think probably not. That's the first problem. And certainly this is reflected in the fact that the US Treasury can only fund itself through short-term debts, like T-bills and debt maturities of less than 5 years. Anything beyond that is actually extremely difficult. And that difficulty is reflected in other nations as well. I don't know what the Australian yield curve is like, but I would suspect that it's not too dissimilar from the yield curve in the US Treasury market and also in the UK gilt market. We're going to end up with huge rate funding problems. And the root of this problem is a GDP, private sector GDP, which doesn't keep pace with the increasing level of government debt. So that is why the private sector GDP numbers are so important for the future of government bond markets. And what you have said, I think, about Australia is also reflected elsewhere, except, of course, nobody looks at it. But I think they will.
Oh, to finish that one off, Darryl, I remember the quote from Mark Twain. You said, I'd rather the return of my money than the return on my money. Money being gold, especially.